Well, good evening and a very warm welcome to this exclusive webinar by the Royal Mint as we reflect on the precious metals investment landscape. If you are watching in the UK today, you'll know that it's the hottest June day on record. So we're sweltering here in the studio, but we appreciate you joining us this evening, I'm sure before the World Cup football starts as well tonight. There's many of you watching us on YouTube and on LinkedIn. The purpose really of this session is to hear from our expert panel tonight, but we want to make it as interactive as possible. So if you can leave your comments and questions across LinkedIn and YouTube there, we will pick them up as the show progresses and put them to our panel this evening as well. This really is a rare opportunity to hear from the experts within the precious metals industry and get that insider view. And of course, I'd like to point you towards our social media pages and the website as well, royalmint.com, and our market news sections too for extra content and reading following the webinar this evening to inform your investment decision. So this feels like a good opportunity now to bring in our panel for the evening. I'm delighted to say alongside me in the studio is Stuart O'Reilly, private wealth consultant at the Royal Mint. And then remotely as well, we've got Michael DiRienzo, CEO of the Silver Institute, Lisa Vainio, Head of Policy and External Affairs for EMEA at the World Gold Council, and then Edward Sterck, Director of Research at the World Platinum Investment Council. Delighted to have you all with us for this evening's webinar. But we're going to start with things domestically, sort of here in the UK and what we're experiencing at the moment at the Royal Mint. So I'll bring in Stuart at this point. What sort of trends would you say are standing out at the moment and customers' behaviour? What are we seeing at the moment at the Royal Mint? Yeah,
it's really interesting. I think the last few weeks in particular, largely due to events in the Gulf and the impact that might have on lots of different markets, actually. I think what we've seen is a bit of confusion in the market almost. So lots of investors sat on the sidelines just waiting to see what's going to happen, whether prices are going to fall further, whether things are going to change in the Middle East or in terms of interest rates. I'm sure the rest of the panel will touch on exactly what's been happening and why prices haven't seemed to be moving in the way that we might traditionally expect prices to move. But it has led to a little bit of a quieter market just for the time being. What we have seen, though, is some of those investors who are perhaps longer-term investors who've been watching the price for a while, saw the price spike earlier in the year and have now decided to jump in and invest at these kind of lower price levels. And that's particularly true today, I think. It's been particularly busy, again, on royalmint.com today because the prices have slipped further. So silver was closer to £44. Gold down towards sort of £3,000 an ounce. And lots of investors are seeing that as an opportunity to get in at the lower price in the hope, obviously, that the prices will rise going forwards.
And of course, it's interesting because in January of this year, we saw record highs. The gold price exceeded $5,000 per troy ounce for the first time. Likewise, we saw a record with the silver price too. At that point in time, were we seeing a lot of investors choose to liquidate their investment with the Royal Mint, or was it a case of holding at that point even?
Yeah, it's really interesting. We had some really elevated trading levels, particularly towards the end of January and into early February when the price spiked. Prices of all three metals spiked quite dramatically and then fell back towards the end of January and early Feb. And what we saw, which I think was quite encouraging from a kind of investment behaviour, from a kind of investment knowledge perspective, from who our investors are, was that when the price spiked, we saw greater selling than buying. So lots of investors were looking at the price thinking, actually, maybe now's a good time to liquidate and I'll take some profit and I might jump back in a bit later. And then when prices dipped, you saw that buying kind of come back and buying outweigh selling again. So, that kind of speaks of an investor base who is kind of increasingly aware of prices and where they are. And I think, it was unusual that the run that metals prices had throughout last year and into this year as well. And I think lots of people perhaps kind of called that top that we saw earlier this year and decided to take some profit at that point. But as I said, today particularly, as prices have slid back further, has been particularly busy on buying. So buying has heavily outweighed selling today.
Yeah, and talking of buying, what questions are customers asking the most? What are they citing as to their reason for investing now?
Yeah, it's interesting. Price is obviously really important to them, and as I said, a lot of them have been sat on the sidelines for a while, just watching prices and seeing what's going to happen. I think increasingly we're seeing questions around tax and political uncertainty and what a new budget might look like. Obviously, in the UK, we are set to have a new Prime Minister at some point. Does that mean a change in priorities in terms of economic and tax policy? And if it does, what does a budget hold in 2026? And I think some investors are kind of evaluating their whole portfolio on the basis that things might change in that upcoming budget.
Yeah, and are investors taking advantage of the breadth of Royal Mint's wealth management products, the likes of gold for pensions, for example, or is it physical coins that they're looking at most of all at the moment?
Yeah, it's interesting. So on the retail side, so kind of your pure retail investors, coins are always our most popular product, and that's because of the capital gains tax exemption that's applied to UK coins. So it makes sense for a lot of investors who are thinking about liquidating to buy that product for that reason. But interestingly, I think some of those people with longer term views haven't been as quiet as some of the other areas of the market. I mentioned retail being a little bit quieter. Where we've seen some really stable demand was actually in, as you said, gold for pensions area and in our business accounts areas. That's UK businesses buying bullion as an investment. Those areas have kind of held up because those are typically very long-term view. Those investors have a much longer-term view. Some of the retail investors might be a little bit more playing the prices and looking at the market. That's not the bulk of our customer base, but we do see that, and we saw that when the price is elevated, that some customers were kind of getting in at that point. But yeah, the kind of long-term view investors, certainly in those two areas, have been really stable in terms of demand and getting in at these prices at this price point.
Very interesting. Thank you very much, Stu. Well, this feels like a good opportunity then to bring in our panel for this evening. And Lisa, if I can begin with you, we've mentioned there that the prices have cooled ever so slightly. What do you think are the factors that are driving the prices we are seeing at the moment most significantly?
Yeah, thanks, Toby, and great to be with you today. So I just want to take a step back and look at the bigger picture here. So last year was truly an exceptional year for gold. Total gold demand, including OTC, exceeded 5,000 tons for the first time. And gold prices set 53 new record highs and yielded really unprecedented value of $555 billion US dollars. So that's 45% year on year. And then gold entered 2026 with quite strong tailwinds, I'd say. So ongoing geopolitical tensions, US policy concerns, and continued central bank diversification away from US dollar reserves. So against this backdrop, gold prices climbed steadily through January, exceeding 5,000, like you mentioned, for the first time. And then they peaked at the end of January and really fell back quite strongly. And Q1 finished with gains of about 3%, right? But this pullback actually reflects a trend that we've seen before, right? So there's a pattern here, and it does not shift the fundamentals that come with gold. So the short-term volatility that we're seeing now is driven by rising yields, a stronger US dollar, and the profit taking that was mentioned earlier following a very strong rally. And also during periods of market stress, gold is often sold to meet liquidity needs. And that is precisely what gold is also meant to be doing for the investor, really providing the liquidity under stress. And we've seen this happen in the past. It happened during the global financial crisis. It happened during the COVID pandemic, where gold initially declined and then subsequently recovered and performed really strongly as uncertainty persisted. So I guess the key point, what I'm trying to make is that despite this volatility, this is a pattern and it's not unprecedented. And gold's strategic role remains intact.
Thank you very much. And if we can shift across now to the silver market, Michael, silver exceeded $100 per troy ounce back in January. The influences that Lisa mentions there, is it a similar story in the silver market?
Yeah, thanks again, Toby. I think what Lisa said really hit the nail on the head. Quite frankly, it took over 40 years for silver to break $50 last November, and it took a few short months for it to cross 100 and then to get to 121 near the end of January. And what we've seen since then are a lot of geopolitical issues that have sort of buttressed the US dollar. The war in Iran, other issues have clearly influenced the precious metals complex and silver as well. But I think what your listeners and more importantly, your investors at the Mint need to know is that there are new floors for these metals that have been set. Silver is no longer a $15 or a $20 metal. It's trading much higher, and it will continue to go higher from where we are today. There's just a lot of volatility in the market at present. There seems to be a strong euphoria for people to invest in AI and tech stocks, at least here in the United States, and that's having an impact on discretionary money, which could be going into precious metals or silver. So we'll talk a little bit later about some of the other fundamentals of silver, but I think Lisa pretty much encapsulated it very well.
And finally, Edward, if we can bring you in, platinum is a critical enabler in the global energy transition. How important now is that in the performance of this precious metal?
Yeah, thanks, Toby. So I think, what is platinum's role in terms of the energy transition? If you look at end uses excluding jewelry and investment, more than 80% of platinum's end uses today are already used, in terms of catalysts and so on, for reducing energy requirements and increasing productivity. And obviously that's really key overall for the energy transition. So it's already a very green metal. More importantly, it's also really critical for the production and use of green hydrogen. However, that market is pretty nascent at the moment. In terms of demand, it's only about 110,000 ounces this year. That's in the scale of a market that's 7.5 million ounces, fairly small. Now we are in a fourth year of consecutive market deficits for platinum, so small changes in demand can have an outsized impact on value establishment. And we are expecting the hydrogen market to grow quite strongly in the future, reaching well over 1 million ounces in the second half of the next decade. However, right now I think platinum, to a degree, with the strong price rally we saw last year, that was catalysed by underlying fundamentals, by the deficits, depleting above ground stocks and so on. But I think going into the fourth quarter and kind of reflecting again on what Lisa was saying, platinum actually began to disconnect from fundamentals. It began to trade much more aligned with gold and with silver, and that really drove the market to the highs that we saw in January of this year. Clearly we've had a reset. Again, this is very much sort of gold-like, where interest rate expectations driven by higher inflation concerns are weighing on the complex as a whole, and that includes platinum. Now, I think, looking at the second half of this year, we can talk perhaps on how we expect that to unfold in the future. But I think the current market uncertainty will probably begin to unwind in the second half, and we'll see things return to more towards the motivating factors that drove higher prices and higher demand in the fourth quarter of last year.
Absolutely. And Edward, if we can stick with you and talk a bit more in detail about the industrial demand side of things. Platinum obviously benefits for more petrol cars on the roads for longer. It benefits from green hydrogen production as well. How important is that industrial demand for the strategic case for platinum moving forwards?
Look, I think it's pretty big. The kind of use for platinum in catalytic converters equates to around 40 to 45% of end demand in any given year, depending upon the rest of the demand profile. Clearly, battery electrification is here to continue, is set to continue. We can question the pace of it, however. Right now we think that the pace of battery electrification is slowing. Some markets, the US in particular, is becoming quite hostile towards the concept of electrification. Incentives being unwound. On the other hand, we're seeing pretty reasonable growth in Europe, driven by the sort of more ready availability of lower priced Chinese battery electric vehicles. But overall, I think we're looking at a higher for longer sort of ICE outlook, internal combustion engine outlook, probably increasingly hybridized. And that's positive for the demand outlook for platinum over the medium to longer term. In terms of hydrogen, as I said, we are expecting that market to grow quite quickly, albeit off a small base. But it is going to be the biggest counterpoint to declining demand from the automotive industry in the 2030s, that's going to be offset by the growth of green hydrogen. And I think there's one thing that's likely to come out of the conflict in the Middle East is, in a way, I think that could be the equivalent of the oil crisis in the 70s for stimulating North Sea oil and gas production in Europe. We could see the same happen with hydrogen, an acceleration of regional hydrogen plans, because it improves regional energy security, and of course that benefits platinum demand in that area.
On that point, energy security, I wonder, Michael, whether that's also a story in the silver market with solar panels and photovoltaics. Is that something that looks set to continue, that trend towards more solar panels?
Well, we think the trend with more solar panels and their installations will continue. Thrifting is occurring in the silver industry with respect to solar. But when you're looking at a solar farm that has a projected 25-year longevity, in order to get the insurance on that, to borrowing costs and so forth, a component of silver is necessary in that project. And, I remember back when silver was $13 an ounce and solar was sort of a new energy source for the globe. They were thrifting them, and they continue to thrift now. But like I said, if you want longevity, reliability, and stability, silver will be a component of solar panels. But beyond that, if you look at what's happening in AI, what's happening in the construction of data centers across the world, silver is a huge component of both those technologies. And it's the best conductor of electricity. So we think, when photography went by the wayside in 2000 and solar started to pick up in 2005, even though we may see a small decrease in the amount of silver basis its high point, you're still going to see other areas of industry use more and more silver, which is approximately 60% of our overall demand, industrial silver use.
I guess, Lisa, the metals differ in that industrial uses account for about 10 to 50% of gold demand globally, and typically it's monetary policy, central bank reserves that dictate the gold price.
Well, yes, that is true. However, I would like to highlight the critical role that gold does play in some industrial applications. Out of total gold demand, it's small. It's about 6 to 8% at the moment. But as said, it is really an essential component in key technologies. And, especially AI was mentioned here, and data centers. So it's seen growth over the past year due to AI, the use of AI, and also the increasing need for data infrastructure. And, gold is actually often the preferred material in many electrical applications because of its unique characteristics, such as it's highly conductive, it's very durable, and also, most importantly, I would say, it's resistant to corrosion. And so it's used in a range of technologies, such as satellite communications, and also everyday devices like, tablets and mobile phones. And so while, the industrial demand is limited, it does play a very crucial role in, the elements that underpin nowadays our modern economy.
To go back and consider geopolitics is a big factor for holding any one of these three precious metals. And Lisa, sticking with you, when markets become more volatile, gold still has a very pertinent place in a balanced portfolio.
No, absolutely, and I would say that in our view, geopolitics is not going to go away. In fact, it is going to be the key driver of this year and going forward. And we've done a number of research pieces on this, and gold does have numerous drivers. And what makes it very unique is really it has different characteristics, or different roles. So it can be a consumer good, it can be an investment, or it can be a reserve asset. And And geopolitics really brings to the fore over the past, 12 months or so. We've seen the crisis in Ukraine. Since then, it's really been quite a volatile economic geopolitical backdrop. And for the past 5 years, that has been sustained by, demand in gold. And we tend to advocate that about, say, 10 or 4 to 10% should be allocated to gold to stabilize your portfolio.
Stu, if we come back to yourself in the studio, obviously gold is a non-yielding asset. Is the points that Lisa mentions there, are those the reasons typically customers would cite when they're coming to the Royal Mint as a reason to getting into gold in the first place?
Yeah, absolutely. I mean, portfolio diversification is something that lots of our customers talk to us about, that they want to diversify away from just investing in stocks and shares. I think there's lots of people who do that, or some of them are holding what they think are safe haven assets, so gold being one of them, but they may be looking to kind of diversify away from things like premium bonds, or they just want to put cash somewhere else that's not a cash ISA. For various reasons, because of interest rates and inflation, or because of limits on cash ISAs and that type of thing. So, geopolitics is definitely important. It does help to kind of get gold into the news, I think, which kind of builds that awareness among kind of general retail investing public about gold and how gold performs. But I think, as Lisa was implying, it is a longer-term thing. So geopolitics, you have events that are happening now, which might drive the price right now, but there's going to be other events in future that will drive it in different ways. And I think it's clearly driven the gold price over the last couple of months with the oil crisis and the events in the Gulf particularly. And I think that's actually led to some confusion, because traditionally people think that gold goes up when geopolitical tensions escalate. And what we saw was that the gold price fell back, even though geopolitical tensions were escalating. And actually, the gold price was going up when it looked like we were kind of coming towards peace. And obviously, that's all bound up with interest rate expectations, how the Federal Reserve might react, and money flowing into things like US Treasuries as well. So that's why gold's kind of had this strange behaviour over the last couple of months, and I think lots of people maybe haven't quite realised that that's what's happened. But hopefully, as soon as we get this conflict resolved in the Middle East, I think gold might become a little bit easier to understand for lots of people, and therefore you might see increased investment as a result of that.
Yeah, and Michael, could the same be said to a certain extent in terms of the silver price that we're seeing at the moment? Stu mentioned a little bit earlier on that we're down around the sort of £45 per troy ounce mark today, and for a lot of investors that maybe started purchasing silver towards the end of last year and saw the highs back in the early part of this year, is gold being impacted in the same sort of way from these tensions in the Middle East to the ones that Stu just mentioned with regards to gold?
You mean for silver? Yes, absolutely.
Yeah.
I mean, it is absolutely true. I think that the whole complex is under some strains, and it's been going on for a few months, and it was exacerbated last week with Kevin Warsh's first Fed meeting, where 9 out of 18 voted to keep rates stable, yet all indications are that there may be 3 more 0.25 basis point hikes through the end of this year, September, October, and November. So that in and of itself is somewhat of a headwind, but the fundamentals of silver are quite strong. And I think that the move north will happen shortly. Will we get to 121 next month? Maybe not, but by the end of the year, Bank of America, Goldman Sachs, JP Morgan say that the average price of silver will be well above $80, and it's currently about 71, 72 today.
Very interesting. I feel like now might be a good opportunity for us to get into some of the questions that have been asked by the audience that are watching along. We did have some pre-submitted questions as well, and we'll open this up, of course, if anybody across the panel has anything they wish to share on this front. The first one being, that was a pre-submitted question, and this goes to you, Lisa. Is Bitcoin a threat to gold, with it being mined to a finite amount, or do you feel as though there's place for both in a well-balanced and rounded portfolio?
Yeah, thanks. We get this question quite a lot, and actually, if the participant is interested, there is a research piece that we did in 2021. You can find it on our website. But essentially, crypto is not a substitute for gold. And over the past years, Bitcoin has acted much more like a volatile equity, whereas gold has lower volatility and tends to perform well when equities fall fast. And in fact, many crypto holders balance their portfolios with gold to offset the volatility that crypto can create. So they use things like gold-backed ETFs or tokenized gold even, or just the physical bullion itself. But more broadly, I think there's an opportunity here with the creation of Bitcoin and other digital assets to improve how gold is used in digital format. And this is something that the World Gold Council is very focused on at the moment. We issued a paper on this back in March, and it's called Gold as a Service. And we basically want to create a shared infrastructure for tokenized gold that can then be used by different service providers and issuers to create that opportunity to bridge the gap between physical gold and the digital gold. And so I know I'm this is no longer Bitcoin, but we're kind of seeing that there is clearly an appetite for digital assets, and we're very keen to mobilize gold and kind of make it more relevant also for the younger generation of investors who clearly are inclined to use their mobile phones and their apps to do their investing. And so this will actually enable that. And just to add to that, so currently gold-backed tokens, it's about a 5 billion market cap. It was in 2025. But I mean, this is really, the potential is to expand that to 100 billion or more if we get this right. So I definitely encourage everyone who is interested in gold-backed tokens to have a look at the work we're doing and contribute their input to that as well. So this is something that is still very much a work in progress. It sounds easier than it is, but we've got a very strong team working on that, and hopefully, we can come back to discuss this a bit later on.
It's interesting. I think we used to see investors quite a lot talk about Bitcoin as digital gold because it shares some of the elements that gold has in terms of it's decentralized, it's finite. I haven't heard it described that way for a long time, Bitcoin, actually. I think people have, as Lisa said, realised that it is a different asset. It does behave differently, and therefore it's not a substitute. It is something that's quite separate. So I haven't actually heard many of our investors talk about Bitcoin and gold in the same breath for a long time now. And
it's interesting, some of the points that Lisa's made there about that younger investor as well. Yeah. We're seeing a lot of that certainly through our customer base at the Royal Mint. Yeah, it's interesting because I think there are lots of younger people who like those digital assets, NFTs and crypto particularly. But in our kind of overall investor base of people who are buying bullion products from us, those younger demographics, so Gen Z and millennials, and younger millennials particularly, are actually overrepresented in our investor database versus the overall UK population. So it's interesting that you've got this younger generation who are very into the kind of digital stuff, who also see the value of something that's physical and tangible and has this really long history going back thousands and thousands of years, as well as the kind of digital new assets that are emerging now. Thank you very much. Next question comes in for yourself, Edward. It's a very broad question, in fact. This comes from social media. Why has platinum, do you think, remained, if you do think this, relatively overlooked by investors?
Well, look, I mean, of the three metals, it is the smallest market. It's also probably the most complex in terms of the number of different end uses. So it requires a fair amount of effort to get to understand and get comfortable with the market dynamics. I think that's probably in an environment where you've got those supply-demand fundamentals being the main driver of sort of value establishment, but very clearly at the moment, as I mentioned earlier, I think platinum is slightly disconnected from those fundamentals and is trading much more aligned with the broader precious metal complex. So looking ahead, through the course of the rest of this year and kind of reflecting back a bit on some of the things we've already touched upon, I think that we could see an environment where Michael talked about the potential for 325 basis point rate hikes this year. Actually, I think that becomes quite difficult for the Fed, principally because of the strain on the Federal Reserve balance sheet as a whole. You've got the highest debt to GDP ever, higher even than at the end of the Second World War. And fundamentally, just looking at things like the short-term Treasury market, so that the sort of US federal borrowing that's constantly being recycled, every basis point increase in rates equates to additional interest payments of $600 million. So it does become quite difficult and quite unsustainable. And although Walsh was very hawkish in his comments last week, we have seen oil and gas prices come back. Maybe that helps those those sort of inflation concerns begin to abate, and that sort of translates into lower rate expectations. I also think that the US economic indicators right now are being slightly flattered by spending associated with the World Cup. People are kind of splurging, and after a splurge, you get a hangover. So, maybe we see those indicators ease off again, and again, that translates into a lower sort of rate environment than people are currently pricing in. And also bear in mind, we've got midterm elections in November, and usually the Fed doesn't make big policy decisions in the lead up to an election cycle. So maybe we've got only one more meeting for them to actually make a decision in 6 weeks' time.
And incidentally, Edward, the questions that have been sort of coming through in the chat and both pre-submitted as well have been around the US midterms that come later this year in November. Historically, what sort of impact and link between presidents have we seen? Certainly, there's a certain link with the gold price. Have we seen something similar varying between presidents when it comes to the platinum price as well?
I haven't looked at that, to be honest with you. So I think, right now, given the precious metal complex seems to be linked as a whole, I'd say that we're probably going to see behaviour similar to that which you would normally historically have had with gold. But that's a supposition, right? It's not backed up by any work that we've necessarily done.
Could I jump in here? Because we've actually done some studies on the midterms, or basically how U.S. elections might or may not sway gold prices. Interestingly, the impact of or the outcome of any election is pretty minimal to the gold price. So this again goes to more about the drivers of gold and it's more about the policy that then comes out of that administration. So if we really want to look at the detail, there is a small shift when it's when Democrats win towards gold, and that usually tends to be Republicans buying it, but it's negligible. And but ultimately, it's more about the expectations around policy, which then start driving, which way gold is going to go.
Stuart, if I can bring you in.
I would agree.
Yeah, well, Michael, your thoughts?
Yeah, I would agree. It's going to be an interesting November this year. Projections right now are that the House could change hands or will change hands, and that it'll be closer in the Senate. But it really is anybody's guess. And if you look at the elections in the last few months, and take New York, for example, yesterday, you're seeing the formation of two sides, a hard right and a hard left. The hard right is very pro-Trump. The hard left is obviously very anti-Trump. But coupled with that is an underlying socialist movement through the three elections we saw yesterday in New York, the election of the mayor in New York recently, and in addition to what we saw in the state of Maryland yesterday. So it almost looks as if people are going to their silos, their bunkers, and have we lost the middle ground in this country? I don't know.
And interestingly, Stu...
sorry, just one thing.
No, go, Lisa, after you. Wonder if you maybe lost Lisa there.
I was going to make one more policy-linked observation as well, which could be a tailwind for all of these metals, which is don't forget that you've got the Section 232 investigation in the US into critical minerals, and you've also got two Section 301 investigations into trading counterparties of the United States with alleged sort of infringement or unfair practices. And those investigations are all expected to conclude within the next sort of 6 weeks or so. Now, what we saw last year was concerns around the potential for trade barriers and tariffs and so on resulted in significant onshoring of metal into the US. If those fears begin to emerge again, then we could see similar behaviour, and obviously that could be a bit of a boost for all three metals.
Yeah, Lisa, we lost you just before Edward
quite
started
frankly,
speaking.
none of us really know, right? We just don't know. We don't know how this administration is going to treat critical minerals. I know silver was recently added, platinum's a critical mineral, but in the United States case, for example, we rely, the silver industry does, on the import of 60% of our industrial and investment use. So I think it would be hard-pressed to go ahead and put a tariff or any other type of issue on silver itself. But we just don't know. I mean, leading up to April 2nd of last year, Liberation Day, as Ed mentioned, there was an extraordinary amount of onshoring, where all three metals were coming, and they were literally on ships off the coast of New York waiting to get into the CME. And quite frankly, if we have a repeat of that volatility, the unknown, we could very well see again what we witnessed from January to April of last year. And again in October in India leading up to the Diwali holiday.
Lisa, we lost you just for a second there before Edward started speaking. So please, if you have any additional comments.
Yeah, no, I was just saying, referring to Michael's point about is there any middle ground anymore, that, we could also see a divided government. And obviously, that has a strong impact on prolonged government shutdowns, extreme political brinkmanship, all of that, which will ultimately then be reflected in any precious metals prices. So, as said, the outcome of that election is not really who is in the House, but, what the policy looks like afterwards.
Right.
Thank you. Let's move on then to another question, and we'll steer this back towards silver, if I may, Michael. A question, another pre-submitted question. I'm hearing a lot about AI. Is the need for silver overstated in AI data centers?
I don't think so, because if, like Lisa mentioned earlier about gold's use and our various components, our iPhones, our computers, our cameras and so forth, silver is also there as well. And there is some controversy with the construction of data centers throughout the world. That is mostly localized with respect to higher energy costs per regions. But you can't put this cat back in the bag. AI is here. Data centers are needed to power them, and you're going to need silver. We don't know how much silver yet. We're still trying to run some studies on how much silver is actually being consumed in the data centers. But we'll have an answer by the end of the year. We'll have a good estimate. We know for solar, we know for EVs, we know for overall electronic and electrical components, but it's going to be a major shift in industrial demand for silver.
Just to jump in, and I don't want platinum to be completely ignored in terms of the AI bandwagon here, but there are AI-linked uses for platinum in terms of hard disks, thin films that go into sensors and semiconductors, but also really interestingly, and a sort of new end use that I think we haven't fully captured in our numbers yet, which is platinum crucibles that are used to grow the crystals that go into the optical links between data stacks in AI data centers. And of course, there are about 8 or so different crystals that are grown in these crucibles. To be honest with you, I'm not an optical sort of engineer or anything like that, so I don't know exactly how they work. It's kind of where AI meets Glastonbury. But the potential demand pull is really substantial. So just China alone this year, we estimate that they've used around sort of the equivalent of around 8% of global demand in platinum crucibles, combined with the catalysts that go into producing silicons for humanoid robots. And that's those are new end uses that I think are being underestimated overall right now.
Perfect timing, Edward, because I was about to ask, is there an element of the industrial demand for each of the metals that potentially people are overlooking or a growth area? So you would say the crucibles themselves, as you mentioned, that is an area to watch.
Yes, yeah, I think crucibles, those sensors and so on that I mentioned, but also things like backup power generation. So using hydrogen fuel cells for backup power supply for these data centers. And just to give you some idea of scale, because these estimates are all very new, it's very hard to kind of actually come up with hard and fast demand forecasts. But China's 15th five-year plan, which was recently sort of published, they're planning on spending $300 billion on scaling AI over the course of this five-year plan. That's sort of compared to about $500 billion of planned spending in the United States. Then you've got sort of equal plans probably in the rest of the world. So you add all of these numbers up, I mean, we really could be talking about fairly significant growth in AI-linked demand, I guess for kind of all the precious metals to some degree.
And then, forgive me for putting Michael and Lisa yourself on the spot. If we could start with you, Lisa. In a similar sort of vein then, are there any uses for gold that are growing that people might want to look out for?
Yeah, I think I mentioned that it's really the data centers that play a role here in increasing the demand for gold in industrial uses. That's as far as I know. There are smaller, anecdotally, for example, this is not something that is going to hopefully happen in the future anymore, but gold was also used in COVID tests. And so, it's just one of those that you never really know when gold actually becomes a key metal and finds a new purpose. I think it's just interesting to keep watching the space and see where technology takes us.
Maybe another one that's a little bit out there, I think, for gold is space travel and satellites. I think people don't realise that gold is used in like reflecting UV rays and stuff, and it lines satellites, and it's used in that. And we're seeing increases in space technology and launches from SpaceX and the like, and more talk now of potential leisure space travel, that type of thing. I think we're a little bit of a way off that at the moment, but it's an interesting area, I think, that's growing, albeit a small part of the market.
Yeah, I think also because of the high gold price, there's a limited use. I mean, back in the day, even children's toys used to have gold in them. But as prices have gone up, obviously you start to question whether we could use another metal to serve the same purpose. But having said that, gold has a very special role because of its unique characteristics of that it doesn't corrode, it's highly conductive, and so forth. So the demand will always be there for those pieces, but obviously less and less so because ultimately the value of the metal is very elevated.
Thank you very much, everybody. Another question for you, Lisa. I've heard central banks are selling a significant amount of gold at the moment. Is this true?
Well, yes and no. So we published our central bank survey just last week, and we found that, in fact, central banks are buying at record levels. So they've increased their gold reserves by about 1,000 tons over the past 4 years, and that is in comparison to the last decade when it was 500 tons. And so the demand is coming particularly from emerging market central banks that want to diversify their portfolios. And the reason why it's less apparent in developed markets is because the gold reserves are already pretty substantial. What the audience participant might have heard is the case of, for example, the Central Bank of Turkey, who did sell about 70 tons of its gold and swapped another 80 tons for dollars. And this was just basically to manage liquidity and foreign exchange reserves because of the impact of the energy shock from the Middle East conflict. So yes, there has been some selling, but at the same time, this is just one policy tool that this particular central bank used, and Turkey has used similar actions in the past, notably during the 2023 earthquake, and also again during the pandemic. And like I said earlier, the selling just again proves the point of usefulness of having gold in your portfolio because of the liquidity that it provides.
We've had conversations with some of our customers as well about exactly this topic, and Turkey is the main example. We've had some comments about Poland and proposals from the Central Bank of Poland. Now, what's happened recently is both because of the increased demand from central banks, so they've been on a bit of a buying spree for several years now, and because of where the gold price has gone, gold has now overtaken US Treasuries as the kind of largest asset that central banks hold. And what you had in Poland was a situation where the governor of the central bank made a suggestion, and it was nothing more than a suggestion, that they could potentially sell some of that gold, take some of that profit to fund some defence spending in the short term, rather than rely on loans from the European Union. Now that was rejected by the Polish government. So that's not what's happened. The Polish bank hasn't sold gold, as far as I'm aware. So it's interesting though that central banks are starting to think about how they use gold in that way, and take advantage of that price rise that they've seen.
And we've seen, of course, in the news more recently, gold overtaking US Treasuries as the reserve asset for many governments. In terms of, and this is a question that, again, that has come through on social media, a question for you, Edward, first of all, if I may. Has platinum ever been considered in the same way by central banks?
I think so. We are aware that some central banks have held platinum in small quantities as a reserve asset in the past. But ultimately, platinum isn't on the sort of World Bank reserve asset list, so it's kind of fundamentally more difficult for central banks to hold it. We actually went to the World Bank quite a number of years ago and asked them if if they would consider adding it, and they were quite open to the idea. But you had to kind of get a central bank to add it first, and then so it was kind of chicken and egg type situation. I think ultimately for platinum, one of the challenges is it is a smaller market. It is inherently less liquid, and as a result of being a smaller market, and so it is just that bit more difficult to be considered as a reserve asset. It'd be great if it happened, but I'm not putting a high probability on it.
And then the same question for you, Michael, if I may.
Sure. So, I mean, we would love it. We would, the industry on the whole, the miners, the refiners, the investors would absolutely embrace a central bank acquiring silver for its balance sheet. In 2005, late 2005, Russia announced that it was exploring looking at silver to add it to its balance sheet. Nothing happened from it. Last year, mid-year, Saudi Arabia announced, not through its central bank, but through a private investor fund linked to the government, that they were exploring buying silver ETF positions. But in terms of a central bank itself, I've heard nothing. No one's contacted us on that. I will say, though, that the United States stockpile in 1986, and that silver was then allocated to the of the American Eagle silver coin. And when it ran out in 2003, the U.S. Congress authored legislation to have the new silver come from domestic, newly mined silver projects, obviously here in the United States. So I've heard nothing to that. We would welcome it. Any central bankers out there, you know where to contact me. Call Toby. He has my information. We'll go from there.
I certainly do.
I should add, actually, that Russia announced last year that they'd be adding platinum and palladium to their reserve asset holdings. But I think that's probably more of a move of desperation than anything else, given they've got quite significant domestic production of both metals.
And noted, I do have Michael's details if anybody needs it. And Edward mentioned palladium there, Stuart. Another question that's come through is whether the Royal Mint has actually considered palladium or copper as a metal option.
Yeah, I think that they're both interesting in their own right. I think palladium is a smaller market, so demand for palladium in bullion form is relatively low. It's not to say we'd never consider it, but it's something that we don't get a huge amount of demand for. Copper's an interesting one. There's an interesting story around copper linked to AI as well, as we've just been discussing, because copper's used a lot, obviously, in wiring. So copper prices have been exciting for investors recently. So yeah, another interesting one. Not a precious metal, of course, but it's something we would consider. We've got no plans.
Just on palladium, there are palladium ETFs that are available. And just as an example, we organise Shanghai Platinum Week, which is coming up in the next couple of weeks. If one was to come to that, there are lots of stands outside in the foyer where Chinese producers of investment products show off their wares. And every year there's been a 5-kilo palladium bar sitting there, ready to be purchased by anyone who's interested.
Perfect, thank you. Sticking, if we can go to you, in fact, Lisa, given your role, we've had a question again through on social media. Does the gold market look very different in the likes of China and India to the West? I guess in terms of sort of customer sentiment, among other things.
That is a very broad question. I don't really know. So China and India are the largest consumption markets of gold, and China is also the largest producer of gold. And these two markets have a very, very strong relationship to gold and the ownership of gold. And I hope I'm answering the question in kind of in the right way. And so the cultural value of gold is just tremendous. And the investors, so I work a lot with, for example, the Indian market in my day-to-day job, and they always are interested in new opportunities to connect with gold. So jewelry is there, a substantial demand for jewelry through weddings, festivals, celebrations, but also there's a clearer shift now towards gold that is in digital format, or through ETFs, so gold-backed ETFs, for example. And recently, you might have seen that there was an announcement by the Indian government about some, restrictions on gold imports into the country. India imports about 90% of its gold. But there was a dip following this announcement, but since then, kind of beginning of June, we've seen again inflows into gold ETFs. So, long story short, India will always have a strong affinity to gold. Consumers just see it in a very different light to most Western markets, for example, and it will just remain a intrinsic to that country. Same goes to China as well, slightly maybe in a different format. And again, they also, in terms of jewelry, they use different caratages. So India, 22 carats gold, China, 24 carat gold. So I guess I'm not quite sure what the question is really asking, but I hope that sort of tries to answer some of that. Happy to also dive into some more specifics around that.
Of course. Now I think that was beautifully summed up. I've got another question in now, in fact, for Stuart yourself, around, I guess, domestic investors that we work with here in the UK. Do you see any common mistakes, or is there one thing someone should consider when investing in any one of these precious metals?
I think to kind of avoid some of these common mistakes is really think about what you're hoping to achieve out of any investment before you go into it. It's probably just good advice generally. And I think that helps you understand whether you are interested in buying coins or bars or something else, about whether you want to buy gold or silver, for example, because they're going to give you slightly different things. So coins might give you the capital gains tax advantage, but silver might give you, as we saw, the recent rise in silver prices was kind of a lot faster than gold. It also can fall pretty fast as well. So silver can give you the opportunity of that rise. So yeah, really step back and think about why you want to invest and what it is you want to get out of it. I think that's the main thing. I think what's changed and what's really encouraging recently is if you asked about 10 years ago what common mistakes were, I would have said that often, particularly retail-level investors buying physical bullion, were just chasing the price. So they would just buy and buy and buy as the momentum in the price kind of grew, and then they would get disappointed when the gold price inevitably doesn't just continue growing forever. You know, it will fluctuate as all things do. I think that behaviour has changed, particularly in the last probably two years, certainly among the people who buy bullion from the Royal Mint, in that we do still get people speculating that prices are just going to keep going higher in the short term and they're only interested in the short term. But actually, most of our investors are now taking a bit of a longer view, and they're not just chasing price momentum. They're thinking about, does the price right now offer good value, or does it not offer good value, based on where I think the price might go in the longer term, 5, 10 years, for example, rather than in the next 30 days.
Perfect. I think we're getting a lot of questions through that are quite difficult to interpret in different guises as well. If I can go back to yourself, Michael, in terms of maybe common misconceptions in the silver market, for somebody that's maybe looking to start investing in silver, is there something they should consider that they may have read maybe in the headlines that could be seen as a common misconception about investing in silver?
Well, I mean, quite frankly, there just are no new major silver projects coming online. I mean, opening up finding silver, discovering silver, especially on federal land here in the United States, can take you 29 years to get the permitting process through in order for that silver to be mined. And you see same situations in countries like Peru. And these are, you know, Peru and Mexico, very mining-friendly countries. So there is a deficit in the silver market. If you add up the last 6 years together, you come up with almost 1 year, 800 and so million ounces of annual mine supply. So this deficit continues. We project it'll be somewhere north of 47 million ounces this year. And, you know, until we start finding more silver, there's going to be a deficit in the market. And yes, there are above ground stocks, but if you look at the LBMA, for example, has roughly 700 plus million ounces of silver on hand. Almost 80% of that is already allocated to currently purchase ETPs and other silver-backed investment products. So it leaves a very small, thin float of available silver to fulfill the industrial and investment needs.
Perfect. Thank you very much. In terms of some closing thoughts then, as we look towards the next sort of 12 months within your respective markets, what's maybe one development, if we can start with you, Edward, that investors might wish to look out for?
Look, I think you know, it's kind of the things that we've touched on to a degree. It's probably some of the sort of macro-political, macroeconomic risks, really, and you know, certainly things that are going to influence inflation and Federal Reserve rate expectations. But on the demand side, you know, there is the potential for these sort of AI-linked demand to accelerate beyond what we're currently projecting. I mean, I think, you know, some of these end users are so new, we probably don't have a good grasp on what the potential is in terms of demand growth. And you know, similar to silver, platinum has been in a market deficit for 4 years. So you know, any incremental growth in demand just continues to eat further into above ground stocks. And as those above ground stocks deplete, of course, you get tighter and tighter market conditions. I mean, one indicator that we watch quite closely, which isn't necessarily easily available to everyone, is lease rates. So that's the cost of borrowing metal. Now, you know, we've seen lease rates across all of the metals, you know, prove quite volatile. Platinum whilst it has softened a little bit from the highs we saw earlier this year, platinum lease rates remain at historically elevated levels. That tells you that the market remains fundamentally tight. And so you've only got to have small shifts in terms of the demand for metals, particularly on the investment side, and that can translate into quite dramatic price moves.
Thank you. And then the same question to you, Lisa, looking 12 months ahead, market development-wise, what do you think could be a force that would have a significant impact on the gold market?
I'm afraid I don't have any further to add to Edward's points. I also would recommend just following the broader macro environment, particularly just the uncertainty around interest rates and also the geopolitical landscape.
Perfect. Thank you very much. Well, look, I feel like that might be a great place to close things off from this investment webinar. Thank you so much for those of you that have joined us for this evening on a swelteringly hot evening here in the UK. I've certainly been struggling in this studio. So a massive thank you to our panel today. Michael DiRienzo, CEO at the Silver Institute. Lisa Vainio, Head of Policy and External Affairs at the World Gold Council. Edward Sterck, Director of Research at the World Platinum Investment Council. And finally, of course, Stuart O'Reilly, Private Wealth Consultant at the Royal Mint. Thank you all for your contribution this evening. And of course, we have so many different materials online and available at royalmint.com. Just head to the market news section of our website. You'll hear from industry experts like Edward, Michael and Lisa and Stuart, of course, as well there. And please do follow us across our social media pages as well. We also want to hear feedback. If there's certain things you want to see in future webinars discussed in a bit more detail, maybe it's a metal in particular or different areas of the Royal Mint business, we would love to hear from you. So thank you once again for joining us this evening, and we'll see you next time.